The U.S. Market Update with Money FM 89.3.
Good morning. Here's how markets wrapped up overnight. We saw stocks in the US and in the day mixed while Treasuries rallied. And this is after data signaling a cooling jobs market last Friday and, of course, over the past few days. And renewed concerns about the health of US regional lenders driving demand for safe havens. So looking at benchmarks, we've got the Dow Jones Industrial Average. That was down around 0.7% or 220 points. The S&P 500 dropped 0.2%, and the Nasdaq Composite, on the other hand, was up 0.2%. So a bit of a mixed picture here. Let's unpack it with Jay Woods. He's the Chartered Market Technician and Chief Global Strategist at Freedom Capital Markets. Hey, Jay, how are you doing today?
Hey, I'm doing great, Ryan. Thanks for having me on. It sounds like you have an exciting lineup today. I want to hear that fruit roll-up story. That sounds riveting.
Yeah, fruit roll-ups. I think that's something all of us grew up with. Now, let's dive into the action that's been playing out overnight on Wall Street, Jay. So we've got markets now looking for some reason, it seems, to move higher because pretty much in the past few days, it's been in a bit of a narrow trading range. What do you take away from the latest action so far?
Yeah, we continue to trade in this very narrow range in the S&P 500. And we've had so many negative headlines here in the United States between the debt ceiling not being resolved, between the regional banking crisis. The Fed has always been making headlines. So we've been waiting on some economic data. And we got that. We got the CPI that came in cooler, 10 consecutive months in a row. The PPI came in cooler as well. And then jobless claims, they ticked up a little bit, which is not necessarily a bad thing. We want to see unemployment, kind of rally a little bit, but not, throw us into full-blown recession. But the things that keep preventing us from taking that next leg higher is things like the regional banks. A lot of interesting action there today.
Yeah, so we talked about the S&P 500 trying to break above that 4,200 mark. Overnight, we saw it down 0.2% to 4,110. And like you pointed out, banks have been weighing on broader sentiment. So if you look at what's happening on that front, we've got PacWest in the news again. It just disclosed it lost 9.5% of deposits last week. And its stock price down over 20%. So how is this affecting the rest of the market, especially in the banking sector?
Well, something changed today. The regional banks have been getting hit since March 6th, March 7th, when Signature and Sovereign Bank had their problems. And the regional bank index, which is the BKX, the KBW Bank Index, is down 33% since that time. The KRE, the regional bank index, is down 38% during that time. But here's the positive. The S&P 500 is up 1.5%. It has not affected the market. It has been limited, except all the regional banks were getting hit. Today, what happened? PacWest said their deposits went down. Before we opened here in the United States, all the regional banks started getting hit again. That's what happened when the first banks went under. Then all of a sudden, we got WAL, Western Alliance. Their CEO, their team came out and said, no, our deposits increased. And all of a sudden, the regional banks, they fared all right. Western Alliance was down less than 1% today. They were down slightly, but they're now looking at each bank individually, and they're not just rushing into just selling every single regional bank. So to me, that's a little progress, and we haven't tested that May 4th low. Watch that. As a technician, I always watch price, like we're watching 4,200 on the upside in the S&P 500. The regional banks, hopefully the low is in, and if there are more problems, which it seems like there may be, it'll be limited to one or two more banks, and we're almost through it.
Yeah, there is that question, are banks being oversold right now? Because if you look at what's been playing out, we've got negative headlines week after week, and people are asking, hey, are investors just selling first and asking questions later? So this is something I'm wondering, is this going to continue for some time? Do we need to see some regulatory action or some sort of intervention before confidence returns to this sector?
We definitely need to see some sort of action. Jamie Dimon talked about this earlier in the day, where he said he'd like to see the government step up a little bit. The FDIC says they want to see the big banks help out a little bit. So there is discussion. Exactly what route we take, that is unsure. The one thing we don't want to see We don't want to see an emergency rate cut as a result of this, because the people here at the New York Stock Exchange, they would see that as a panic move, that, wait a second, it's so bad that we had to cut rates. So right now for the Fed, they're pausing. The data is cooling. This is good. Hopefully we pause for the next 1 or 2 cycles. If anything, I think we may have a rate hike one more time before the end of the year. But the fear, I think, is if we have some sort of emergency rate cut. And that, to me and to the team down here, means, something's wrong. And we could get a sell-off as a result of that.
Yeah, that's a good point. The optics are quite important, right? How you signal to markets, your expectations. And this is interesting because last night we saw the Bank of England doing a major upgrade in their expectations. So you might remember not too long ago, they're talking about how the UK would be going through the longest ever recession. That was what they were predicting last night. They said that's no longer the case. So things are evolving so fast. And on what the Fed is facing, you've got many different opinions. I am looking at some headlines. People are expecting rate cuts to come in the second half of the year. And the Fed is saying, hey, that's not the case. So you have this mismatch between what the Fed is saying and what the market's expecting it right now.
You're absolutely right. And I think we have to listen to Jay Powell very carefully, because he has telegraphed every move. And even a very hawkish governor like James Bullard came out and said last week that it may be time to look at the data and see how things digest. So we're taking this as a positive step. We don't see any major move from the Fed now, but it's TBD. We'll see what happens. And I have to apologize. There's a little noise in the background. I'm at the New York Stock Exchange, and here it's after hours, and there is a party about to go on behind me. So I apologize for the background noise.
All right, well, in conversation with Jay Woods, he is a chartered market technician and chief global strategist at Freedom Capital Markets, speaking to us from Chicago on the trading floor. What's the party about, Jay?
What's the party about? First of all, New York Stock Exchange. I want to give my city all the credit. I'm not sure what the party is tonight. If it's anything, it says Mad Money behind me, so it's something to do with Jim Cramer, who I hope you're a big fan of here at CNBC.
Yeah.
But we have parties from time to time. If you're ever lucky enough to come to the New York Stock Exchange, see a bell ceremony, there's nothing like it. And then if you're lucky enough and you're with some sort of event, they will host people here, and you get to have some drinks and some hors d'oeuvres and hang out on the trading floor. And then you can meet people like me who can tell you about my 30 years trading down here. It's pretty exciting.
Yeah, Jay, just wrap things up. We've got the debt ceiling issue also overhang market sentiment.
Yeah.
What's the latest here you can tell us?
Well, the latest here is I'm watching price action. As a CMT, we watch price first, and the market isn't panicking. It's a big headline. We remember 2011 very well. That was the debt ceiling debate. That was also a default on our AAA rating here. And there was some China problems. There's a lot going on, but a lot of people keep hearkening back to 2011. The S&P sold off 19% when we went through the debt ceiling and we didn't pay our government workers. Well, we also had debt ceiling issues in 2013, 2018, 2019, and the market was stable, if not up slightly. Right now, the market is stable. We think that both sides of the political spectrum here in the United States will get their act together, and they may delay. They may go 6 more months down the road, but they will come to some sort of resolution. Now, if it goes in past the weekend, that could get me a little worried that Monday we could see a little sell-off, but we continue, as we started this segment, in that range. And the range is narrowing, and what I like that the price action is, when we go lower, we make a higher low every time. That's constructive. It's boring, but it's healthy to try to get out of this. And then let's look at the leadership. I'll close with this. Google up 5% today. Amazon breaking out. Apple, Microsoft at new highs. This is the leadership you want when things are turning around. The breadth is not strong. I realize that. But eventually, the troops will follow the leaders. The leaders are not going to retreat and follow the troops.
All right, that higher low is quite constructive, as you say. Hopefully, we have seen things bottom out. We'll be chatting with Jay Woods. He's the chartered market technician and chief global strategist at Freedom Capital Markets, speaking to us from New York. Jay, thank you so much for your time. It was a great conversation.
Oh, great to see you. Thank you so much.
Money FM 89.3